right now we're going to get back to one of the market-moving stories of the day. Mixed news on housing. Existing home sales resumed their decline, but foreclosures also fell. Joining us now with his outlook for housing, which has yet to recover from its slump, is Jay Brinkmann, chief economist at the Mortgage Bankers Association. Jay, thanks for joining us on this jam-packed news day of IPOs and international political bail hearings. Let me ask you, though, about before all of this stuff, the housing market was probably the most interesting thing that we spoke about here on Bloomberg. And it is interesting because it affects a lot of Americans on a day-to-day basis. Is this market in any way, shape, or form prepared for recovery? Because out of the last 10 investment strategies we've spoken to, only one of them has been optimistic.
It depends on what aspect of the market you're talking about. Clearly, prices are still, in some number of cases, declining or flat. But one measure of the health of the market is what's going on with delinquencies, because we're not going to see prices come back until we see foreclosures end, soak up some of that supply. And that's what we're seeing, that there are signs of a market on the mend. We're looking at it as maybe the third stage in a type of recovery. First stage was dealing with all the subprime, low doc issues. Then we had the recession. Now we're getting into the area where some markets are recovering, but we've still got some numbers dominated by some really bad states. But 90-day delinquencies, those have been falling now 5 straight quarters. Some of the biggest drops we've seen in both foreclosure starts and foreclosure inventory. There are some good signs in these delinquency numbers.
Foreclosure inventory is interesting because when I hear that foreclosures fell, I think maybe that's not a good sign, right? We want to get these things through the pipeline, don't we?
It might be a bad sign if we were seeing things back up on the other end. But the fact that loans that are 90 days or more past due but have not yet entered foreclosure, because they saw a fairly steep drop and have been dropping for 5 quarters now, that indicates we don't have as big of a backup behind the foreclosure process. Yes, we've got problems in certain areas. Florida, we've still got a lot of problems with the system in Florida that's going to back it up even more. But we've got other areas where it's moving through. Most states had drops in the rate of new foreclosures started. So I don't think we're going to have as big of a backup that perhaps we were facing with 6 months ago.
And we saw delinquencies drop as well. Here you see the states, by the way, with the highest foreclosure rates. Not a shocker that you see Florida and California there, but Illinois. Why Illinois? I mean, it seems the Sand States had the worst reputation, right? And Illinois is smack up there in the Midwest.
Illinois has had ongoing problems with jobs, with the economy. One of the things that keeps the Illinois number so high is the nature of the foreclosure process. States that have a judicial process, it just takes a lot longer for a house to move through. So even if they have the exact same rates of delinquency, the same rates of foreclosure started, you're just going to see much larger numbers of homes sitting in the foreclosure process trying to get through the court system. New Jersey's kind of the same way. New York, California, actually, we're seeing things move through. Arizona, these states have more of a judicial program, and we can move things through the process a lot faster.
I wonder about, we had a guest on earlier, Ed Yardeni, famous, of course, for coining the phrase bond vigilantes, but looking at interest rate policy. I mean, he worked for the Fed. He has been the chief economist at a number of different banks. He thinks that if the Fed would raise rates, and if mortgage rates indeed were to rise as well, that would be incentive to get buyers back out there in the market. What do you think about that theory?
I don't think so, and for this reason. I don't think interest rates drive the purchase decision. Certainly they drive the refi decision. The purchase decision is largely driven by, do you think, if you're worried about how the value of a house may change, how values are going, much more driven by personal situations. A couple with one kid can get by with two-bedroom apartment and a 1-bath. The second kid comes along, they start thinking, I need a house. That decision's not going to be driven by whether interest rates are 5 or 5.5 or 6. It may influence how big of a house they can buy, but it's not going to influence the purchase decision itself.
When are we going to see, and how would we see family starts picking up, or home starts? And I'm not saying to build a house, you understand, but people who need to go out and get a household.
Right. The good news through all this is we have seen an expansion in the household formation rate through 2010 with the jobs numbers that we've seen so far this year. We know that that's increasing still. Most of those increases in household formations have been going into rentals. Eventually, some of those people will be going into home purchases, but the first step is to have this expansion in the household formation rate, and that's what we've been seeing. Not as fast as what we need, but at least it's been positive, and we're going along with the positive job growth.